Good afternoon. Thanks for tuning in. You're watching Countdown on BloombergQuint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. Markets are off today's low, led by a recovery seen in metals and PSU banking stocks. The Nifty bounces from levels near its 200-day moving average, while most sectoral indices still remain in the red. Cipla trades with losses and is among the top Nifty laggards after its Goa unit got a warning letter from the US FTA. India Cements is locked in upper circuit for the second day in a row. Gopikishan Dawani bought 2.6% stake in the company through a bulk deal yesterday. And private equity giant Blackstone is set to be taking over a technology park promoted by Coffee Day Enterprises. The stock, however, is locked in lower circuit, and that's a Bloomberg exclusive. Good afternoon, Neeraj. Market seems to be off the day's low, so some respite actually coming in from that 200-day moving average levels.
Yeah, one just hopes, Navneet, that this is not like yesterday, wherein the Dow Futures were in the green when we were trading and then collapsed about 3%. But let's wait and watch. She's right. We're off the lows of the day for sure, about 1/3%. The Bank Nifty for a brief moment broke into the green, currently just about there. So as you can see out here, and quite a strong gain that we had from the lows of the day. Actually, so it's been a pretty decent outing. The market breadth should come up on your screen for just a moment before we talk about what individual stocks have done. So pull up the advanced decline ratio and you will see this converging, right? The breadth was really adverse. Now we are less than 2:3 in favor of the declines, and that's, or 3:2 in favor of the declines, and that's actually a pretty good sign. Get the heat map up on the screen. It was overwhelmingly a touch of red at the start of the trading day. Now you can see the greens have clawed their way back. What's leading the charge? Well, Yes Bank notwithstanding, there is Ultratech Cement, there is Britannia. State Bank of India is up about 1%. There is strength in Axis Bank and HUL, which actually had a pretty decent outing in the session today. There's a brokerage note, I think, which has come out on HUL yesterday or today, and that's why that stock too has done okay. Bharti is in the green, Coal India is in the green. So those are those specific pockets, not too many heavyweights, but for SBI and HUL, which are looking like giving some gains. But the losers also don't have really a large heavyweights. I mean, Reliance is down about 1%. It was down about 1.5% at the start of the trading day. But GAIL corrects another 3.5%. Sun Pharma about 3%. Tata Motors and the globally linked names continue to grind. So Tata Motors, Hindalco, etc. have all corrected. And Maruti continues to lose out. So 1.77% now down for that one. By the way, the yen's loss is Maruti's gain, but somehow the market is not looking at those technical factors. It's just looking at the kind of earnings momentum that might go away or might not come back, as a result of which that stock continues to grind lower. But Devina, what about the broader end of the spectrum?
But the broader end of the spectrum, small caps, surprisingly, Neeraj, the last few days have managed to hold fort. Today's session too, while the mid caps are in tow with what the large cap index is doing, the small cap index is actually performing much better. So that's in the green by about 0.1% or so. And quickly moving on to individual movers, and then before we wrap, I'll just quickly look at Europe as well and how that's trading. So for today's session, Varun Beverages stacks up as one of the top gainers here, 3.5% higher. Nippon Life Asset, India Asset Management is up 3%. Glenmark Pharma, Torrent Pharma, so some gains coming back into the pharma space and some players out there. You've got PNB Housing Finance up 2%. What's losing out is Future Consumers, Amara Raja Battery, which is down heavily, about 4% and 5% respectively. Emphasis is down about 3%. Godrej Industries along with Sterlite Tech are also trading weak in the session. In the small cap space, much of the action continues in today's session, and you've got gains coming in the likes of India Cements. We had that as a headline as well. Key players entering the stock, and the stock's up 20%. Spandana Spurti is up 7% in trade right now, so that's going to be a big mover. Along with that, remember we spoke to the management of Credit Access Grameen, and they're also on a firm footing, 30% growth, CAGR growth for the next 5 years, so that gives you a lot of visibility. Diwan Housing Finance, Lakshmi Machine Works, or some of the other stocks. Metropolis continues to do well, and this is overtaking Dr. Lal in terms of the momentum of gains that you're seeing in the stock. Losing out today is Lemon Tree. Once again, some weakness building in there. Stocks down 7%. Timken India, you've got Raymond, which is down. Dish TV, BEM, and Avanti Feeds looks weak today. It's down about 2.25%. Quick glance across Europe, and then we just get a sense of what's been happening in the futures and options space. This is what we've got in terms of the Euro Open. The Open was actually stronger, just like yesterday, but once again, the weakness is overwhelming. You've got DAX down 1%, CAC is down about 0.6%, and so is the case with FTSE 100 as well. Coming back to our markets then and the futures and options space, interesting to see if any trends are emerging from there. Navneet is joining us to tell us that. Navneet, good afternoon.
Good afternoon, Davina. Thanks for that. Well, clearly, market seems to have taken support at the 200-day moving average, which was breached in the opening trade today. And remember, for majority of the session, we've traded above the mark of 11,700. So that will be a key level to be watched now on the downside. Rollovers are still at about 52%, so not picked up too much from yesterday's closing, but definitely there are fresh positions that are being taken. As you can see, even the February open interest is up 15%. For Nifty Bank, which is trading around the levels of 30,400 thereabouts, and there also we are witnessing some fresh positions being taken across February as well as the March futures. Volatility Index should come up on your screen, and remember, markets are off days low, but that's not the case for VIX. Actually, VIX is at days high, so remains to be seen whether this pullback lasts or not, or it'll get sold into. Most probably, it should get sold into the way VIX has been behaving. 17.4, it's up about 3%. Options data, 11,700 call has seen some writing in trade today, so 9 lakh shares have been added there. 11,700 put, while on the other side has added about 22 lakh shares. And I said for majority of the session, we've traded above the mark of 11,700. So definitely bulls will look to defend the mark of 11,700 now. And 11,750 call, also just want to highlight, that's seen aggressive riding of about 13 lakh shares so far. I think the range will be somewhere about 11,700 first on the downside to about 11,800 on the upside for tomorrow's expiry. Stock futures, Ultratech is off today's low. It snapped the 4-day fall, so that's doing pretty good in today's trade. In fact, it's bounced from its 50-day moving average, and futures are indicating some fresh long positions are being taken here. Look at that. February futures, remember, expire tomorrow, and the open interest is up about 19%. Divi's Laboratories, one of the outperformers in the pharma pack, is back in action today. Long positions seen. 37% of the quantity so far which has been traded has been marked for delivery. So that gives you a sense that more of cash-based buying has been seen there. And YTD basis, of course, it's performed really well. It's up about 16%. Lastly, Amara Raja, the stock's down 12% now in last 4 sessions. Yesterday also it was down 3 to 3.5%. Fresh shorting was seen there. It's fallen towards its 200-day moving average, and futures have been indicating fresh shorting coming for this counter as open interest has surged across February as well as the March futures.
All right, let's get into market voice then. Aishwarya Dadich of Ambit Asset Management is joining us right now on the show. Aishwarya, thanks very much for taking out the time. What is the call at Ambit right now, keeping in mind the developing factors globally as well as domestically?
Thank you so much. Definitely there has been increased volatility globally, and what we are witnessing is there's a risk of sentiment which is building up on account of this epidemic, which is like spreading all over. And there's so much of uncertainty how it will impact the global trade and, especially GDP of the developed countries like China, Korea, and probably now into European markets and economies. But what we believe is India is somewhat more impacted because of its own, macro issues. If you look at the way this last quarter went by, what we saw is that there was a very muted operational performance of all the companies, especially on the earnings side. We actually have, in the third quarter, we degrew by 6% for Nifty 50. Because of the tax cut, we have grown our PAT of almost around 8-9%. But if you see the last 9 months, things has been very bad. So on the earnings side, and that recovery is what is very, very important for our market to remain beyond going ahead. In the meantime, if things deteriorate further going ahead on account of this epidemic converting into pandemic going ahead, we'll see more and more pressure coming on from the global side. And at the US market, which is almost like an all-time high with very high valuations, could find it difficult to sustain at those levels. But having said that, what we believe is there are a couple of things I want to highlight upon. We might be, so we will be reporting our GDP number very soon, but we might be very close to the bottoming out of those cycle. We don't try to crystal gaze the future, but what we believe is that things will probably see a more of a U-shaped recovery than a V-shaped recovery. And on the earnings side, as I mentioned to you, that there have been some issues on the earning growth, but there are a pocket of companies or sectors which have been able to show some kind of momentum on the earnings side. So at Ambit, what we are managing funds like Good and Clean Mid-Cap Fund, as well as the Coffee Can portfolio. And if you look at the 9-month earning, especially when the things have been so bad, we are almost seeing more than 25% CAGR growth for the last 3 quarters for the portfolio, compared to say almost 0% growth for the mid-cap index, or almost like 7-8% growth for only Nifty 50 in that side. So there are pockets of sector, there are pockets of good companies which are still performing very well during those tough times. And we believe those are the sectors in which those leaders with those right, good and clean mindset, and which are run by able management, are still available at relatively visible valuations. And those are the ones which an investor should look into for wealth creation going ahead.
A report of yours, you spoke about, it's highlighting quite a lot of companies. You have companies like Alkyl Amine, GMM Pfaudler, Safari, VIP Industries, and you've spoken to managements of all these companies. Are these the kind of companies that you're looking at?
So we, as I mentioned to you, that when we are meeting a lot of management of those kind of companies, the undertone has been cautiously optimistic. If you ask about them on the capex side and the visibility that they have about the businesses, most of them are like playing very safe, except for chemical as a sector where we are seeing some capex happening. Most of the other companies are still waiting to see those demand upturn or the signs of demand upturn taking place, and then only they will try to go and do those kind of capex and do this kind of commitments. But the companies that you have talked about, and there are many other such companies, even in say some housing finance space, NBFCs, even some good private sector banks, some home building names, even most of those consumer names, they continue to remain optimistic about things. So those companies have basically survived the toughest of those times, right, because of those tough macroeconomic environment. And when this thing's recovery happen, the more of a U-shaped recovery, probably it will take say 2 quarters to 2 years. Whenever it will happen, these kind of companies will disproportionately benefit more on their operational performances. And when it happen, we all know that stock prices are just slaves to earnings, and we are very a bit on those kind of businesses and those kind of sectors where we believe there's momentum on the operating performance side, especially on the revenue, EBITDA, and PAT growth, where we believe that they will have shown sustenance in the past and will continue to do in the future, are the area we want to look and be invested into. So all these names are very, very a bit on the sectors. They are doing the right innovation, the right product strategy. They are gaining those market share gain, and the managements are quite a bit on the strategy going forward also. And we remain very optimistic on that thesis going ahead.
Okay, Aishwarya, the other question is, if you have, or if you're getting money right now, are you putting all of it to work, or are you sitting on some bit of gunpowder because of all that's happening around the world regarding coronavirus?
So we normally don't believe in timing the market. We don't normally believe in taking cash calls. If we like a business, if we believe that business has an earning momentum going ahead, and if we believe that those earning momentum are available at a reasonable valuation to us, so in short, what we follow is a GARP model. We normally deploy the money then and there. Now, all of these 3 tick box that we have is applying on our portfolio businesses as of now. So as of now, majority of almost 90% of our investments, we are making it the day we are getting the cash, because we are very a bit on the businesses that we are holding. And they have not only phenomenally done well in the last 2 years on the operational side as well as on the price of those stocks, but we are very excited about their future outlook also. So we are deploying those money, instantly on those 90%. But there will always, when you have 16 names in your portfolio, there will be always like 1 or 2 names which have just seen a very strong growth on the price front in the last, say, probably 8 months or 12 months, where valuations have been stretched. On that side, we normally try to, at least just put our leg into and try to wait for an opportunity to get into a better price. But that would be like just 1 or 2 instances. For the rest of them, we are deploying those money instantly as the money comes. And that strategy has been working for us even in the worst of the last 2 years, if I have to say that. So the good and clean mid-cap fund, which has almost like 80-81% of mid-cap and small-cap exposure, where mid-cap index has given more than like 9-10% negative return CAGR in the last 2 years. The good and clean mid-cap fund has given a positive return of more than 10% CAGR in the last 2 years. Similarly, on the emerging giant, which is more of a small-cap fund, we have seen the same performance on the index side, where the index has been negative more than 10% in the last 2 years. The fund has given a positive low single-digit return, but still it has not been able to destroy value. So we have been able to maintain that drawdown. And for the coffee can portfolio, which has given almost like 20% return in the last 2 years, where the Nifty has given 5% return. So all of the three funds we have been able to generate significant alpha, and as well as we've been able to limit our drawdowns. And this is normally has happened because of our ability of sticking to the process, sticking to the basics of investments, trying to find out the businesses those which have those right traits on capital allocation, which are clean on accounting, clean on corporate governances, and which has a bias toward earning. It's the best of those mid caps, the best of the large caps, and the best of the small cap is what we ended up in creating a portfolio, and that's what the return has generated over the last 2 years.
Sure. So basically, Aishwarya, you're saying one should use these corrections to deploy money into good quality stocks if they're holding or they wish to hold in the future. But tell us one thing, is there any specific sector that you guys are looking at closely which according to you can outperform in 2020?
So if I were to just bifurcate these two things, what we believe is that this is a right opportunity. Probably we don't try to, as I mentioned, we don't try to crystal gaze the future and how this virus thing will go and impact the global side. But if you look at the last 7-8 impact of hit of the virus to the global market or the population, when things stabilize, there has always been a great return which comes. So we believe it is a good time to invest into the quality businesses, those good and clean businesses where we have a lot of comfort on earning as well as on the management. Having said that, we believe there are sectors which really excite us. We still believe that chemical, specialty chemical as one sector we are very upbeat about, and we believe that this sector will benefit meaningfully for the next couple of years going ahead. There are some companies which are doing phenomenal works on innovation, in market share gains, in creating the right product, in creating the right R&D and be in the global market. And we believe this China thing on the pollution norms and will meaningfully benefit all this sector from India. And at the same time, it's just not because on account of one variable that things are going around, because more of a price. It is the consumption per capita which is increasing. The cycle for chemical is coming out of the blue from the last 4 or 5 years globally. And we are seeing the order book of all the leading chemical companies in India has grown manifold in the last 1.5 years. And this is what we believe is an opportunity going ahead too. We believe that real estate is a difficult sector, and we believe that it will take more and more time to revive. Right. But we are also very optimistic on home building as a segment. We believe tiles player, paints player are something which will do meaningfully well going ahead.
Okay, Aishwarya, thanks a lot for joining us and taking us through your...
We continue to like...
Yes, please complete your point.
Thank you so much.
All right. Okay, we'll leave it on that note, Aishwarya. Thanks a lot for joining us and taking us through your thoughts on the sectors where you guys are bullish on in 2020. But on to the latest from the coronavirus, where the global death toll has reached 2,761. Other than China, South Korea has emerged as the newest hotspot for the virus, with the infection surging past the 1,000 mark. While Asian markets have ended in the red, but off the lowest point of the day, let's discuss all of this with Michael Every of Rabobank and understand what sort of repercussions this can have on global growth in this year. Hi, Michael. Good afternoon to you from India, and thanks a lot for joining us today on BloombergQuint. While the spread of coronavirus continues to rattle global equities, we've seen how the equities have been behaving across regions so far this week. Do you think the damage has already been done with respect to markets, or there is more to come, as a lot of reports indicating that the global growth will be impacted now due to this?
Well, obviously it depends on how the situation with the virus pans out. That's a no-brainer. But were we to continue to see the trend in cases and deaths and the global spread move in the direction that it has been over the past few days, I think that the market damage we've seen so far is merely just the start. I mean, okay, we're off 7% so far this week in major European and US indices, 6 to 7%. But we were up more than that so far this year anyway, on the back of, frankly, nothing. And that doesn't even begin to factor in just how bad this could get if we are to see large sections of the global economy shut down in the same way that China has been, with tourism and trade collapsing. That's far more than 2-3% down days you're talking about there in any real world.
Right. Michael, you said there is more to come, so there could be more damage which could be seen for global equities. We were just reading that for U.S. market alone, it's wiped out $1.7 trillion in market cap in last 4 sessions. How much more damage do you see in terms of drop in key indices there and also for other markets?
Well, first of all, in terms of 1.7 trillion, I could care less what the number is. It's about 6 or 7% in terms of the headline index. And obviously, the higher the index goes, the more dollar value there is attached to a smaller percentage move. All I can say to you is just imagine if the U.S. Center for Disease Control is correct, and I fear they will be, in their assessment that there will be, major pandemic outbreaks of coronavirus, COVID-19, somewhere in the continental U.S., and that you will see major U.S. cities having to go into the kind of lockdown we're now seeing in Milan, for example, in Europe. Were that to occur, and you have a 27-day incubation period for this virus to try and bring it under control, you're talking about a month's worth of shutdown if you can manage to control the thing in the first place. How can that not have enormous downside potential for U.S. equities and hence for global equities? I'm just frankly gobsmacked that even by the standards of how stupid financial markets have been over the past couple of years, that there are still people out there thinking that the damage is already priced in because they've gone down 6 or 7% in 2 days.
Yeah, in fact, Michael, that is going to be my next question with regards to whether or not short-term equities are set up for a big volatility swing, and the fact that there's an extremely narrow breadth for equity markets which have been accompanied by a polarized positions in other financial assets. Do you think that that's going to take center stage now, aside from equities?
Well, I mean, if you're talking about the tension between the bond market and the equity market, I've argued consistently that the bond market is always right and the equity market is always wrong. It may take a long time in each of these instances before the bond market gets to be proved right, because there's always a lagged effect, particularly when you have central bankers throwing away free money at everybody and everything, thinking that somehow this will keep propelling growth forwards. Now, it does do absent a killer virus, but as soon as you get a virus coming along, that means everyone stays at home, either voluntarily or are forced to, therefore they're not buying anything, and demand is destroyed. And at the same time, supply chains are destroyed because nobody's working, so you can't get intermediate inputs and you can't produce goods to sell them on to other people. You can price equities wherever you want, in theory, and central banks can throw as much cash into the economy as they want. It doesn't do any good. I mean, if you were to give $1,000 to everybody who's under lockdown at home during a virus, what are they going to do with it? Eat it.
That's what Hong Kong's
It doesn't do a lot of good until things return to normal.
Yes, yes. In fact, that's the other point is, if at all, even when we're talking about China and the kind of stimulus that they're talking about, it needs to come on the back of some amount of certainty that employees are going to get back to work, factories are going to start, and then the stimulus makes sense. Otherwise, it's just, money put to waste.
Absolutely. I mean, the stimulus even then makes sense, provided, as I said, as we both agreed, that the virus is permanently sorted out. If it goes away for a few months and comes back in the autumn, then you've got a W-shaped pattern where down, up, and down again, which is not any way to run the global economy either. But I remember also, even this stimulus comes at a cost. Fiscal deficits are going to blow through the roof. Where's the money coming from for that? Is it going to come from central banks again? Okay, great. Well, we've tried money printing in the past to get our way out of real problems, and it's never worked out too well for mankind generally. So I don't see why it will work out better now. And the structural issues that will linger after this of an overly powerful central bank and an overly powerful government having gained the power to decide who lives and who dies during the crisis, financially speaking, is going to linger on for a very long time. If you think markets were corrupted by the global financial crisis, imagine what's going to happen during this virus crisis. And I don't see that being positive for anything other than maybe the largest stocks, who are probably going to be too big to fail in exactly the same way that they were back in 2008, 2009. But whether there's actually any real underlying value in that is a very different question.
Well, maybe the inverted yield curve signals of last year are getting proven right by this virus. Michael, just one question. If indeed the bond markets are right and the equity markets are taking time to reason with that, how much downside do you foresee? Is it possible to predict that?
Downside for equity markets?
Yes.
Well, I mean, throw a dart on the board. I mean, as I said, equities are supposed to, in the world that, we grew up with the textbooks that we grew up reading, equities are supposed to be, or the price of equity is supposed to be discounting a future flow of earnings, isn't it? Well, what are your earnings if you don't have any kind of economy? What are your earnings if everyone's sat at home, bunkered up, wearing a face mask, not doing anything while they wait for this virus to pass? And, God forbid it should mutate and become even worse like Spanish flu did 100 years ago. Obviously that's a tail risk. But it's a tail risk one would presume that anyone rational would want to be pricing into any equity at the moment, given if you're wrong, the value is effectively zero, isn't it? I mean, if people can't go out and do anything, to produce anything or buy anything, where are your earnings? Your earnings are zero, so therefore your price should be zero, surely. But, obviously the market isn't going to trade like that, particularly with central bankers pretending that they're virus experts as well as being economic experts, and in fact they're neither. And throwing more and more liquidity, hoping that liquidity is greater than transmissibility. But, transmissibility in terms of how rapidly this virus spreads and fatality in terms of how many people it kills, I fear, are going to outrank liquidity. And central banks are going to be shown to be, the emperor with no clothes.
And, all right, got that. Michael, it was really great to get your thoughts on the show. Thank you so much for joining us. And it's important because while we may talk about a lot of liquidity being there in the system, how much of that is going to be put to use in such an environment to make investment decisions?
That's pulled out for sure.
Yeah, it's been pulled out for sure.
Frantic clip of late.
And also, an interesting data point that I came across today was the pace of the fall in the U.S. equity markets. That is, the Dow, S&P, NASDAQ has been the sharpest and the fastest since the year 1927. So at that clip, I mean,
the last 2 days, is it?
The pace of the drop from the highs has been the fastest since 1927. The drop that we're comparing in terms of the ferocity of the fall that's happened in a matter of 2 or 3 trading sessions.
Well, the percentage points notwithstanding, but the quantum of points certainly, because the markets would be that much higher. But yeah, it's an interesting statistic nevertheless, and we are in the US markets, for example, are around the levels that we were in October 2019. That's the way it is. Anyways, let's move on. Star Cements, and let's get in a quick corporate conversation going, because cement companies are actually doing rather okay. Star Cement has particular news. It saw its volume rise in the third quarter, but realizations took a hit. The East India player also ramping up the capacity by 50%. Sanjay Kumar Gupta, the CEO of the company, joins us on the phone line to talk about these. Mr. Gupta, good having you. Thanks so much for joining in. Put this into perspective. What's happened is great. Sum that up for us. But what you did in the quarter gone by, can that get replicated in the current quarter or the quarters to come?
So the last quarter, in quarter 3, we have done an overall volume growth of around 14%. Northeast was around 15 to 16%. The quarter 4, the cement demand is good, both in Northeast and Eastern segment. And we hope to do even better quarter 4 numbers. So our expectation is that the quarter 4 overall number growth will be 20%.
You mean the volume growth, sir? Or the overall?
Yeah, the volume growth will be around 20%.
Volume growth will be 20%. And I have realizations picked up with such demand?
We have seen some price increase in Northeast of around 10 to 15 rupees. We also have seen some price increase in Bengal, Bihar, Jharkhand market. The prices have actually went up by around 25 to 30 rupees, but they have dropped back. So net impact will be around 10 rupees.
Net impact would be about 10 rupees. So with a 20% volume growth in quarter 4 and some price increases as well, and I'm presuming that efficiencies also kick into play, are we actually looking at a much better performance, though not comparable on a quarter-on-quarter basis, but a much better performance in quarter 4, Mr. Gupta? Would that be a fair assessment?
So we have reported an EBITDA margins of around 1,300 rupees a ton on quarter 3. We hope to report the EBITDA margin of around 1,500 rupees a ton.
Mr. Gupta, you said prices have gone up in both the regions where you have presence, Northeast as well as the Eastern region. But tell us, are these prices sustainable? Because I believe, it is, especially in the Eastern regions, they've also come off from the higher levels that we've seen.
So going forward, we think that there will be good demand of cement coming up because in FY21, our expectation is that the overall cement demand growth in both in Northeast will be better than FY20. The reason being, 3 large states in Eastern India are going for elections. Bihar is due. Then in FY21, there will be elections in West Bengal and Assam. So that will lead to some kind of an infrastructural spend from the state governments. So hopefully FY21 will be better than what we have seen in FY20. So on the back of the strong demand, we hope that the prices will be sustainable.
If you expect the demand to come back, then you also expect the non-trade orders to be there in the coming quarters?
In Northeast, we have seen some uptick in non-trade orders also. NHPC has floated a tender for their installed project of Subansiri, Lower Subansiri in Arunachal Pradesh. So that is a big project of around 2,500 megawatt. Hope once that is the construction of that undergoes, it will generate a good amount of cement demand for northeastern sector. Overall, in the eastern sector, there is uptick in infrastructure development in last quarter and also in this quarter. We hope till the season lasts, the uptick in infrastructure demand will continue.
Mr. Gupta, last quarter, I believe the trend was, of course, the volume growth went up for many players, but it was the realization sequentially which came off. What trends do you foresee in the current quarter, considering the prices have gone up, but it remains to be seen whether they can be sustained in the month of March or not? So what's the outlook on realizations?
See, our expectation is definitely there that the prices will sustain. Yes, there has been quite a few capacity addition in eastern region. And there has been some consolidation has also happened. Imami going to Revoco will actually have some impact on the price stabilization. So our expectation is definitely there that the prices will not fall from here and will have an upward bias.
So in light of that, what would your realization trajectory be, Mr. Gupta?
So last quarter we had a net realization of around 6,100 rupees per ton. We hope that it will be somewhere around 6,200 to 6,300 rupees a ton for the quarter 4.
Okay, just to get a sense of the pickup in terms of your total capacities and utilization thereof, you're saying the demand is starting to pick up. So would you be looking at increase? What is your total utilization, capacity utilization right now? And then would you spruce that up?
So we are operating at around 70% of our capacity. Our one plant, 2 million ton CWD plant is starting in the month of March, end of March or early February, early April. So with that addition, we'll be seeing that is going to come up for the and that plant is going to operate for the full financial year in FY21. After that, we have plans of setting up 2 million ton clinkerization plant in Meghalaya. We will also add about 1 million ton of grinding capacity in Guwahati. We are also planning to set up a 15 megawatt waste recovery plant in Meghalaya. So we have around 12 to 1300 crores of investment lined up in next 24 to 30 months.
Okay, that's the next 2 to 3 years. All right, Mr. Gupta, we'll leave it at that. Thank you very much for joining in. Appreciate you taking out the time. Mr. Sanjay Kumar Gupta there of Star Cement talking about business. Hope to see realizations improve to 6,200 plus in the upcoming quarter. Demand is picking up. 92.5, it's up about 8.5%. Coming back to the markets, and we're at the lowest point of the day, I assume, right now, at 11,678, and that's down below the 200-day moving average. And making our approach towards the lows of the budget day, that's 11,633. Now that is not in the realms of possibility in today's session, considering we're just about 40 points away from that. But let's see whether or not some bottom buying comes in at this point. Nifty banks down about 0.5% plus. That's 200 points shaved off the Nifty bank as well. Brajesh Singh of Stock Access is joining us on the show. Along with him, Ruchit Jain of Angel Broking 2 is here with us. Gentlemen, thanks very much for taking out the time. 4 to 5 straight days of losses. The structure looking extremely weak. Probably 4 days ago, if someone would have said go short, you would have still managed to make some money. But today, after the kind of declines we've seen, is it prudent to go short further? Brajesh.
Good afternoon, Devina. See, the the problem right now, Nifty on the hourly chart was giving a little bit signs of the confirmation that we might see a bounce back. And till morning, it was been holding a 200 simple moving average. Now, in a couple of minutes back, say hardly 15 minutes back, we have seen a selling pressure, and the Nifty had broken the 200 simple moving average and it's been trading below that. The daily charts had made the confirmations of more going down with the oscillator front, followed by the price pattern. I was been looking at least Nifty might be holding 11,670 mark, and when I posted my strategy, that was my stop loss. But now it looked like the probability that Nifty might drift down more and might retest the previous swing low that was 11,615 or say 11,630 around, and chances are that it might even break that level. Now, where on the higher side has been concerned, Nifty the first resistance lies at 11,770, followed by the important resistance zone would be 11,850. Now, Nifty has to be closing about 11,850. Then only we can say that that bear grip has been over and Nifty has come out from that zone. Otherwise, chances are that we might drift more. So my strategy was on the buy side. Now, looking the present scenario, if someone wants to play for a sell side, I would be saying keeping a stop loss of 11,740, go for a sell side and play for the target of 11,615, followed by 11,550 mark. So we might see in March series that we might try to touch the level of 11,550. Then from there we can see a little bit bounce back.
Richard, what should be the ideal strategy now? We've corrected nearly 3.5% in last 7 sessions. We're approaching very close to the recent low of 11,615 as well. Do you think it will be appropriate to create a fresh short position, or one should wait it out now?
Hi, very good afternoon. Well, we have already seen a decent correction in last few days from the high of around 12,200. Within no time, we have corrected to 11,660 now. So I think the risk reward ratio for creating fresh shorts over here are not that favorable. Couple of reasons. One is the recent swing low of 11,615, which you mentioned. Secondly, in the options data, for tomorrow's expiry, 11,700 put option has good amount of open interest built up. As of now, we have not seen unwinding in that. Now, in case if we see unwinding in that, then we could see some further drag towards 11,600, 15,600, that swing low. But just for that 70-80 points, after this already the market has corrected about 500, 600 points. So the risk reward ratio is not favorable to create fresh shorts. I would say if any existing short positions are there, then keep a stop loss above 11,720 now, and around 11,600 to 11,620 square of the existing short positions. But certainly not a point to create fresh shorts over here.
Okay, that's the point. Don't create fresh shorts is seemingly the advice, though the markets may be headed lower. We are very close to some key support levels as well. But you got to keep in mind that as much as people would have thought that there is an afternoon of recovery, the Bank Nifty, which almost broke or actually did break into the green, is now down about 0.8%. So it's a very, very sharp slide downwards for the Nifty Bank. Look at that. It hit the peak and then it's just completely come off. So keep that at the back of your mind. Just pull up the Dow Futures. I'm just interested in seeing whether the Dow Futures, which are trading in the green, about 60 odd points just before we started the show. Yep, that's the problem. From the green, I think the Dow Futures too have corrected about 1%. So there you have the problem. 2 days on a trot, the US markets have corrected about 3% or thereabouts, and now likely to slide more. But before we move further with our guests on the specific comments, let's get in a quick snapshot of a story that Bloomberg put out some time back. Private equity giant Blackstone is said to be taking over the technology park promoted by Coffee Day Enterprises. Anto Antony joins us right now with more on this story. Anto, fill us in. How would this be a layered kind of a deal with money coming in at different points of time? What are you learning?
That's right. This will be a layered kind of deal in which about 150 crore will be coming in today, with another 2,000 crore coming in over the next 10 days, and the rest of the money coming in by end of the year. So this deal was really delayed. This, as you recall, the non-binding agreement was signed in August, but the deal was delayed because some of the lenders, including Yes Bank, didn't give a no objection certificate for the transaction to complete. So finally, all the pieces have fallen in peace, and Blackstone has started taking over and will be making the first tranche payment today.
Showing in the way some of the stocks have done today. But interesting story, Anto. Thank you so much for bringing it to us today. And let's see how this shapes up. But it definitely brought about some excitement in some of those lenders. Yes Bank notwithstanding, RBL Bank too spiked up in trade when this was put out on the Bloomberg Wire. So keep that story at the back of your mind as well. But we're on the topic of markets, and let's first get one fundamental opinion before we talk about specific stocks from our technical experts. Dipan Mehta is here as well. Dipan, good having you. Thanks for joining in. Just looking at the unpredictability of the situation, as we learn, Iran cases have moved up. Italy, the cases have spiked from just being centered around northern Italy to the rest of the country too. Would you believe catching this fall is not a good idea? Let's sit put. I mean, people should stay put, wait for the dust to settle, and then take an investment decision?
I think so, and depends on the cash level in the portfolio. And if you're more or less fully invested in just 5-10% cash, then better to just conserve that cash, because we are in uncharted territory, and these markets have seen many geopolitical events, including war and weather pattern changes and spikes in commodity prices. But this is something absolutely new and difficult to have an assessment as to how it will actually play out and how it will actually come under control. So when you are in uncharted territory, better to be cautious and just keep conserving the cash in play. But then again, on the other hand, if you have a large corpus to invest, 30-40% of your portfolio is in cash, then these are good levels to start gradually buying into equities, especially good quality companies. And although valuations still remain a bit high, but then that's what is doing well, and will continue to do well in 2020 as well. So that basically is our assessment.
All right, just looking at the index now, and it's a free fall. I mean, we're now 7 points away from the lows of the budget day. That's 11,646 now. For the Nifty, and it's just a one-way slide that you're seeing on the index. It's already, remember, September is when the corporate tax cuts were announced. The index rallied 16% to make record highs at somewhere closer to 12,400 odd. From there, we've retraced closer to 6.5% post today's fall, 6.5-7% post today's fall. So, can't really put a finger to say how much more downside is there, but it's definitely opening a moon door, looking at the fact that we've already breached the 200-day moving average on the downside. Dipan, while we're talking about cash conservation right now, for people who have exposures to high beta pockets which are affected negatively because of coronavirus, and the fact that we don't know how much further this downside could last, does it make sense to then get out of those stocks? Not to say that you're making fresh investments, you're conserving cash, but you would rather protect capital as well.
Oh, absolutely.
Yeah, that certainly could be a strategy, but these things are very difficult to assess and actually implement. And companies which may get affected by coronavirus may be down just now, but tomorrow or a week from now, if this entire threat is addressed and no longer a major issue, then you will see these stocks come back also quite violently on the upside. So I think it's better to just stay put and hope that this particular storm will pass away, and at some point of time it will get under control, and then whatever has been hit badly because of whatever reason will come back, revert back to mean. And that I think would be sensible at this point of time, because there is no like a deadline as to when this particular issue will actually get addressed. My sense is that as and when we see a lower number of cases globally, more and more confidence will come. And at the same time, I think the economy post-coronavirus threat globally as well as domestically was on the upswing. And with more cheap money coming in, it's only going to make it that much more attractive. So I wouldn't want to sell off the ones affected by coronavirus negatively at this point of time.
Okay, 11,666 on Nifty. Volatility Index has also moved higher. So keep an eye. Remember, tomorrow is also the expiry day. 8% higher. Remember, we told you markets had recovered at 2 o'clock, but VIX was still at higher levels. That pretty much gave you an indication the pullback will not be lasted and it got sold into. Let's get you some trading ideas then at these levels. Ruchit, you're free to change your levels considering the markets have moved a lot in the last half an hour. What are the key strategies in terms of individual stocks that you're recommending?
I would continue with the levels that I had given. I have one sell and one buy recommendation. Primarily, one of the theory that we are applying over here is to buy the outperformer and sell the underperformer. CESE is one of the stock that is showing some good underperformance. The stock is trading in a falling channel. Recently, also when the markets have shown an up move, we have not seen any kind of significant participation from this stock. So I think now when the markets are correcting, the stock would continue its underperformance. The lower end of the channel is placed around 640, which could be tested. So at current levels, one can go short on CESE with stop above 686 for target of 640. And one of the cash-based stock, Crompton Greaves Consumer. This is one stock that we have been recommending since last 1 or 2 weeks. Primarily, we have recently seen a breakout with good volumes. Now, in spite of the falling market, the stock is not showing any price-wise correction. Rather, it's a time-wise correction, wherein the 20 days exponential moving average is acting as a very good support for the stock. So, when the markets are correcting, this stock is not correcting. I think this is a good sign. So, at Crompton Consumer, with a stop below 272, which is the swing low, could be bought at current levels for targets around 315 in short term.
Okay, Brijesh, what about you? Your strategies would be?
Navneet, I have 2 calls, both on the long side. Number one would be Ambuja Cement. Now, in this type of market, Ambuja Cement is a little bit outperforming. The stock had broken out from the range of 202 or 205 on downside, followed by 212 on the higher side. Now it's been trading somewhere around 214 zone. So one can look out to buy at the present rate with the strict stop loss of 210 and pay for the target of 222. Time frame to hold the counter would be 2 to 4 trading session. Another call would be Havels. One can look out to buy at the present rate 642 or 643. The stock has been quoting with a strict stop loss of 638 and pay for the target of 668 to 670, and time frame would be same as 2 to 4 trading session.
Okay, so those are some individual trading ideas coming from our technical experts. We've been talking about the cement companies. In fact, a while back, we spoke to Star Cement as well, clearly highlighting that the prices have gone up in the month of February and they expect the prices to last at current levels. And India Cements, remember, is the other one, which has been in focus after Gopikishan Damani bought 2.8% stake in a bulk deal yesterday. It's locked in upper circuit. In a weak market like today's, this one's definitely getting some attention. Dipin, in terms of cement space, which is, if I look at this individual stocks, maybe just a handful of them, Ultratech, or for that matter, just Shree Cement could be the one which may have given you good returns in the last 1 or 2 years. Overall, because of dip in the demand in the last 1 year that we've seen, of course, the companies have come out and said on-ground situation may not be that well. Capacity utilization levels also continue to be on the lower side. But there are signs of volume growth picking up, at least. That's what we saw in the third quarter. Is there anything in the cement space that you're tracking closely?
So I think a lot of mid-cap cement companies will play catch-up with the likes of Ultratech and Shree Cement, which are done exceedingly well. And if the last 3-4 quarters are all about profitability going up because of cost savings and lower input as well as logistics cost, I think the next 3-4 quarters would be on account of higher volumes. And we are seeing that volumes are picking up for the cement industry. There is decent price discipline as of now. And the gains as far as the costs are concerned or productivity is concerned still have been retained by the cement companies. So I think next 6 to 12 months would be excellent for cement stocks. And my sense is that the mid-cap stocks in the cement industry, they could see a mild re-rating of their price to earning multiple. So the likes of, say, Birla Corporation or JK Lakshmi or Dalmia Bharat, I think all of these companies which are trading at a discount to Shree and Ultratech will try and close in the gap, and you could see outperformance in the tier 2, tier 3 cement companies rather than the likes of Ultratech and Shree Cement, which anyway have been great performers over the past 6 to 12 months or so.
Okay, I think we've come back from the lows of the day, almost closer to 0.4% recovery from the lows of the day that we've got on the Nifty 50 at least. So still under 11,700, 11,682. Naveen, fluorine continues to do well. after that order. And yesterday's session 20% higher. Today's high was, I think, about 10%. It's trading higher by 6.5% today. Alkyl Amine, that's the other one that you should, pull up to see. And that stock's doing well too. And it's been constantly in the last month or so done really well. The likes of a Suven Life again locked up on upper circuit, 4% for Alkyl Amines, Suven Life another 5% upper circuit, Divan Housing another 5%, JB Chemicals another 5%. In today's session, you've got Varun Beverages, which is doing well, about 8.37 on the stock. Quick take, Ruchit, do you track Varun Beverages at 837? Is it a buy or would you hold?
I think one can also initiate fresh longs over here. Primarily after a sharp up move in the in the initial couple of weeks of January, we have seen some sideways movement which have resulted in the formation of a bullish flag pattern. Now till this recent swing low of 775 is intact, I think the stock should show some good momentum in the near term. 900 to 920 would be the target range for the stock. So at current levels, keeping a stock below 775, one can initiate fresh longs for targets around 920.
Jesh, Naveen Fluorine, would you be a buyer after it gained 26% in 2 days?
See, volume breakout has been witnessed on the Naveen Fluorine, and the stock has two important support right now. If someone wants to go for a long side, one is 1320 and another is 1405 zone. So keeping a stop loss of 1405, one can look out to buy, not at the present rate or any dip till 1500, and look for the target of 1625 to 1640 zone.
Yeah, I think it might just pay to be mindful of the volatility that exists right now in the world markets. Remember yesterday CBOE VIX surged past 30, and that was the highest level since 2018 if I'm not wrong. And speaking of volatility, while we were talking about how the Dow Futures were in the green at the start of the show, they are now down I think about 350 points. So look at that sharp fall in Dow Futures, 12,708, 410 points, and look at that sharp crack that has happened. Now one doesn't quite know, if you just look at the functions on the terminal and try and figure out what stories are coming out with regards to the virus. It's spreading in Italy. The Korean cases have gone up, Iranian cases have moved up, and the first American soldier stationed in South Korea has been detected with an infection, and therefore all of this would be plaguing the minds of the market right now, because this is unpredictable stuff. Nobody quite penciled this in, and it's now expanding, and it's certainly having economic impact. And I think that's probably one reason why the markets are nervous. You're prepared for central bank action to come in and help whenever there is weakness on the economic front. How do you combat this? And I think that's probably the reason why we are nervous. The question is, Dipan Mehta, what do you do with the global cyclicals? I think we asked you a question earlier about what, how do you tackle all of this, etc. One is whether you don't buy them. The second question is, because this is so unpredictable, would you try and get out of these companies, say the Tata Motors, Motherson Sumis, or a Vedanta, Hindalco, or even the steel companies for that matter, because this is so fluid that even if you want to hold them in your portfolio, you might get them at much better valuations a few months down the line or a few weeks down the line, just simply because of the landscape surrounding us.
Yeah, I think the companies you mentioned, we are not very positive on those companies because of different reasons per se. But maybe not today. If you see a cycle, mild upswing, tomorrow, day after, some sort of a pullback or short covering, then certainly you should lighten up on these companies which you mentioned, the software companies or Tata Motors or Motherson Sumi. I think wherever Indian exports are to sectors which are anyway under a bit of a stress, those may be kind of avoided. At the same time, I think we should also discuss that post this coronavirus, whenever that point is reached, we will see again a further sea change in the global supply chains, and already global supply chains are moving away from China for environment reasons and for many other reasons. I think that entire process will hasten, and that will benefit many Indian companies, many Indian exporters who have been finding it tough because of Chinese competition. So pharmaceutical companies, specialty chemicals, auto ancillaries, engineering companies, garments, home textiles. I think all of these sectors, of course there'll be a bit of a lull just now, but I think all of these sectors will find the going a bit better because of the fact that the large buyers, global buyers, the Western companies, the large MNCs may find it now more conducive to have at least a large sourcing coming in from India as well. So this is a bit of wake-up call for a lot of the global trade, and I'm sure that maybe not immediately but few quarters or 2-3 years down the line, we could see India's share in global trade significantly improve as compared to what it is just now, purely on account of this particular development, which is a bit of an eye-opener for many companies and managements.
Importantly also, Michael Every was saying just a few moments ago, that when you're talking, you need to be mindful of the fact that you do not really believe everything that you hear on the street. Also, the fact being that when you're talking about much of the fall being priced in, you're not considering what corporates are telling you. And that's where much of your years need to be listening to what corporates are telling you with regards to how this is going to impact functioning for them for the next quarter and the quarters upcoming, if this extends itself beyond Q4 and obviously Q1 in the US. But that's something you really need to pay attention to. And this is just a drop of 6% from the highs for India. That's not, we've seen sharper cuts.
It's not a table-thumping drop.
Yeah, we've seen sharper cuts. And for something which has been touted to become a pandemic of sorts, I mean, we're still pretty okay for ourselves, 11,687 right now. But in the midst of all this, there is a glimmer of hope, Dipan, and that comes from the specialty chemical space. Now, there is opportunity in, I'm forgetting.
A bunch of companies which are actually trying to
I was
supply.
forgetting the saying, but what I'm trying to say is specialty chemicals is the pocket where adversity is an opportunity for them. And a lot of people buying into some of these specialty chemical stocks. Would you buy that story, Dipan, right now?
Yeah, as I just said, I think that if consumption was the driving force and the main investment theme across 2019 and 2020 so far, my sense is that from this point on, a lot of export-oriented businesses will find favor with investors, and there'll be the expectation that these companies will also undertake backward integration to reduce their dependence on China, as and when they see visibility as far as their revenues are concerned. So within the specialty chemicals, companies which are engaged in contract manufacturing, agrochemical contract manufacturing, like say a PI Industries or a Heikel, or then pure play specialty chemical companies like Aarti Industries or SRF, Naveen, and we saw the deal that Naveen got recently, and maybe smaller companies like maybe a Deepak Nitrite or Vinati Organics. These also, I think, investors will try and price in higher growth rates for them. And then there are the entire pharmaceutical companies, especially those which have got complete backward linkage into APIs and bulk drugs as well, which have got a good amount of scale and cost benefit. Companies like Ipca Laboratories or Granules India, Laurus Labs, Divi's Laboratories, not the ones which are focused on many products like the likes of say Dr. Reddy or Sun or Lupin. I would avoid those, but more focused players, something like an Alchem Laboratories, which have got a few molecules in the US markets and global generics market, but are very strong in terms of manufacturing and process over there. So I think a whole host of these companies will suddenly start, I think we should start benefiting as the markets shift towards purchasing more from India, and that could be a good defining theme of the rest of 2020 at least.
Okay, let's just mark few stocks as well. We've already highlighted some chemical companies. Spencer's is the other stock which is up about 13 to 14%. I think we should pull up BASF India too. It's up 13%, and after touching 52-week low of 809, I think the start was in the red. The stock's seen some bit of buying interest from those lower levels and is currently sitting almost at the highest point of the day. Fairchem Specialty, another chemical player which is up and about. This is also at 52-week high. And have a look at IOL Chemicals. This has gained 60% so far in the month of February. It's the coronavirus play once again, as ibuprofen prices have shot up nearly 30 to 40% due to that. that this has been going up. IOL Chemicals is up about 60 to 70%. But I want to pull up certain companies which have been falling as well. We've been highlighting Amara Raja Batteries has been quite weak in the last two sessions. So today, the selling pressure, I think, continues. It's down 4%. Motherson Sumi is the other one. After a bout of short covering yesterday, I think this is back in red, down 4% in trade. Ruchit, come in here on these two stocks or pick up any one. Do you think the downside or the fall is done, or there is more room for somebody to, play a short position here, be it on Amara Raja or, for that matter, Motherson Sumi?
I think we have seen very sharp sell-off in last 3 days in Amara Raja Batteries. The stock is now hovering around its 200-day moving average, but in spite of trading near that support, there is no strength seen in the stock. So I think if any kind of pullback move is seen, the stock would again resist around 700, 705, and ultimately it could go lower towards 640, 650 kind of range. So the short-term trend for the stock continues to remain negative. But yes, since the 200 DMA is there over here, so I would recommend to take a sell on rise strategy over here, 700 to 710 range. If we see on any pullback moves, that would ideally be good range to create fresh shorts over there.
Okay. Dipan, before we let you go, a question that now crops up quite regularly is what happens to companies which have a large domestic presence and are still coming off. Maruti Suzuki is a case in point. The stock, the sales have fallen too, but the stock price too is corrected quite viciously. On valuations or otherwise, would this be something that you would keep on your radar?
No, not really. I think the entire fundamentals, medium to long term, for the auto industry need to be reviewed. There certainly is something which we're not able to get a handle on. Could be shared mobility, could be electric vehicles. I don't know what exactly it is, but maybe the kind of growth rates that the industry had for the past 4 or 5 years or so, that may be a thing of the past, and it will grow more sedate, maybe mid to high single digit, and that also will be a struggle. So we're looking for exit opportunities within the auto space, and there could be a few exceptions in the two-wheeler space, maybe in the tractor space, but largely I think when it comes to commercial vehicles, when it comes to passenger vehicles, we want to get a bit cautious from this point on. I think the entire passenger vehicles are going more on the consumption theory, and I think the consumption patterns are again changing over there, and if you want to play that particular theme, then maybe you should be excluding auto from that and going for some of the other sectors and industries where there is still consistent demand and growth from urban as well as rural. So specifically coming to auto, I'm a bit cautious over there and would like to look for exit opportunities, especially in a stock like Maruti.
For exit opportunities, especially in a stock like Maruti, well, that's a dramatic change, right, in how the sentiment around autos has become. Dipan Mehta, thanks so much for speaking to us today and giving us your perspective. Really appreciate your time. Mind you, about 4 quarters ago, when TVS Motors numbers had come out, there was a talk with Dipan about how those numbers seem game-changing. Maybe he still has a positive view there, but I think in autos in general, he made a comment that he'll probably look out for exit opportunities. Okay. There are a few stocks that might be still doing okay, while the larger pack is not, and might be good to get in Yash Upadhyay's list of the Fab 4 stocks of the day to try and figure out which are those that are standing out. We've marked a few, but Yash, what's made it to your list?
Well, it's one of the days where overall there is a significant amount of weakness, but there are still a handful of names which are doing very well. Godavari Power and Ispat is one name. It gained almost closer to 6 or 7 odd percent earlier in the day, and that is on the back of the company announcing starting operations at its rolling mill as well as iron ore beneficiary plant in Chhattisgarh. They had earlier in the month announced that they had received the necessary environment clearances, and these new plants will help them in terms of their sales for the value-added products. ITD Cementation has received a minor update with respect to their credit rating. So the outlook on their long-term credit ratings has been revised upwards to stable now from developing with negative implications. So that is a big positive for the company. India Cements is up for a second straight day. It's locked in an upper circuit of 20% after we came to know from the bulk deal data that Gopi Kishan Damani has bought in closer to around 2.8% stake in the company, and in just the last 2 trading sessions, the stock has gained somewhere between 37 to 37.5%. But another name that is doing extremely well is Navin Fluorine. It's up closer to around 6% in today's day of trade as well. Remember, yesterday it had received that large order of almost close to 3,000 crore rupees, and we are seeing that continuation take place for a second consecutive day. But take a look at its performance over the last 3-month period, and the stock has rallied almost 78% since the end of November. So really good gains coming in for Navin Fluorine and some of the other chemical names as well.
All right, Yash, thanks very much for that. Just want to pull up the point contribution of the index right now, the Nifty 50, to see where this drag is coming from. Obviously, Infosys and Reliance Industries do stack up in the order because of the, they are down 1.7, 1.8%, and they're both heavyweights. Alongside that, L&T is also down, and ICICI Bank is contributing 12 points to the downside. And the rest, obviously, total of 82 points. But far and few, I think that's about the list. I think another 2 or 3 stocks in the green for the index, and HUL is one of them. Yogesh Mehta of Yield Maximizers is joining us right now on the show. Yogesh, tough times, but what advice do you give?
Yeah, Divina, it's a really tough time because last time when we spoke about that Corona can affect the market sentiment big time, and that has now come up. That has been surfaced. But I think, yes, it is good that quality stocks were so expensive that even if I want to buy for my portfolio or for my customer, it was too difficult to buy. Now, since the price have corrected, it is giving some sigh of relief, but still I'm just waiting for more correction if it comes, and then would be able to check the list whether one should enter into the for the portfolio buy or not, because the severity which we are seeing right now or witnessing right now in the market, it seems that maybe some more downside is left, and probably in the last history, if I compare when I was reading an article, it shows that whenever in the history such kind of pandemic has happened, market has corrected almost between 8 to 12%, worst case scenario 12%. So even if I consider 12,400 odd is a high, then at least 50% will be 11,550, and then if I see that further correction, then 11,000, 11,200 would be much more comfort level to get into. So around this level, I'm just preparing the list where growth story is still intact.
Okay, let's see whether there is any recovery which comes by. Remember, so far in the recent past, we've taken support at 200-day moving average. Markets have bounced back. Remains to be seen what happens now. Nifty is once again back below its 200-day moving average. And while for Nifty Bank, we did breach for a while, but it did see a bit of bounce back from those levels of 30,165 thereabouts. That's the 200 DMA there. Nifty Bank right now 30,242. Okay, I just want to pull up the top loser on Nifty, and GAIL has been actually trading with sharper cuts throughout the day. It's not that it fell with the markets in the second half. Of course, currently it's at the lowest point, but it opened flattish, and then since then it's been grinding lower from there. Brijesh, how is this one looking on the charts? It's at 107, 108. I don't know if it's breached any key levels today, but would you take any position here? Is there more downside left for GAIL?
I mean, weekly as well as the daily charts both are indicating the probability of it can move more down. Now the previous swing low was somewhere around 112 or 113, and it has broken that level with increase in volume. So keeping that thing as a stop loss, present rate or any rise till 110 can be used for going short, and look for the target of 98 to 99 rupees.
98 to 99. Let's see whether that target gets reached or not. But GAIL certainly today has been really weak. In fact, in the last 1 month itself, the stock's down about nearly 16 to 17%. The other one, which is trading with cuts, is Thomas Cook. They have a board meeting today to consider buyback. I think the price remains key at what level the buyback takes place. But ahead of that, you're seeing a sharp correction of nearly 9%. I think majority of the gains which came in post the company said that they will be considering a buyback have been given up now. Some of the other stocks which are still holding on to the gains is RBL Bank, which was up and about yesterday as well, and something like Glenmark too, which is up in trade. Richard, any thoughts on RBL Bank specifically? It's been holding its ground. Yesterday also it was up 2 to 2.5%, and today as well it's seen gains of 1%.
Yeah, I think yes, relatively to broader markets in last couple of days, the stock has managed to show some up move, but the charts are still not indicating any kind of uptrend over here. I would take this just as a pullback move. On the higher side, 335, 340 continues to be the resistance, as since a long time the stock has not breached its 89 days exponential moving average. So I won't advise creating fresh longs over here, since the broader trend is not that positive.
Yogesh, what's your take on SBI ahead of the SBI Cards IPO, as well as, you've got a brokerage upgrade as well on the stock? Price target of 375, I believe, has been put out on the counter.
Yeah, Devina, that's correct that everybody has, all the broking houses have hiked the price target for SBI due to SBI card IPO. But it is there since January end, and the hype has already been built up. The valuation are also a little expensive. If it is around 755 rupees IPO price is decent enough to have 30% CAGR over next 3 years growth rate is visible. But already the grey market premium is quoting at around 350 rupees, so which will eat away at least for next 1 year's return. So I would wait for that price. Secondly, on your question, SBI, yes, the valuation for this 1 lakh crore market cap, which would be a listing day, whenever it will list, then it shows that there will be a sigh of relief for SBI for many for diversifying their into the subsidiary companies. So that will give some relief to the balance sheet. But I think that has been more or less is priced in. If anybody is buying for SBI card, then one should not take that approach for portfolio buy. I think still NPA levels are much higher, and it will take further 2-3 quarters to have some clean to clean up the books. And it is not that they are not doing any further deterioration into the slippages, but it is been maintained with the lower pace. I think one should avoid getting into the portfolio for SBI, because the returns will not be more than 10-12% in next 1.5 years. Rather than that, one should look at if it comes down below 300 or 280, it is a good level to enter into. But at 330, I don't foresee that SBI card will give any boost to the stock price.
I have a counter question there, considering there is so much frenzy around this IPO now, and you've of course highlighted the pricing that they've come out with, the valuations according to that considered to be on the higher side. Little too early to ask this question, but if you're lucky to get shares in the IPO process, people who apply for it, would you recommend them to book profit if you get a listing day pop-up of about 40 to 50%, or it would make sense to hold on to the stock?
Only 40 to 50% will be too difficult, because if it happens, then yes, it will be to book profit, yes, definitely. But around 900, 950, I would be comfortable holding it. And since listing day, we will have some volatility. But for long term, I think, as I mentioned, 30% for next 3 years growth rate is visible. And since the business is very new, to evaluate that on the balance sheet number, it is too difficult, because it is something like it is very new to its own kind, and new balance sheet. So number needs to be understood, and there is no comparative valuation available so far in India. So I'm just waiting for that. But yes, on listing day, if it happens at 50%, profit can be booked, yes.
All right, and that's most likely going to be the case, because if you're expecting a 1 lakh crore valuation on listing day, and that's somewhere closer to 1100 odd rupees in terms of the listing price itself, which I guess is something that Yogesh also spoke about in terms of the grey market premium, which currently stands about 350. But in two other stocks from the microfinance space that I want to focus on. One is Credit Access Grameen. We spoke to the management in the morning. Talks about a 30% CAGR growth for the next 5 years. The stock today is down, but it has been an outperformer. But what's doing well is the other one, that is Spandana Spurti. This has also been a recent listing, and in today's session, that stock is up about 5.5%, 1158 on Spandana Spurti today. Ruchit, any of these two stocks that you track, Credit Access Grameen or Spandana Spurti?
Thing is, if you look at the charts, then Spandana Spurti has given a breakout from a consolidation phase today, and on the high side, the stock in near term could head higher towards 1300 kind of level. So at current levels are on minor declines. If we get the stock again around 1120, 1130 range, it would be a good strategy to create longs, keeping a stop loss below 1020 for targets around 1300.
Okay. That's Spandana Spurti for you. And, the other pocket obviously is, the real estate pocket. DLF, Brigade, Prestige. Yesterday's top performing sector, rather, when you had the pharma index losing out. Real estate was the one that held out. Today as well, Brigade is up, Prestige is down. Mixed cues coming in there from there. But Yogesh, is this a pocket that you will look at?
Yeah, Devina, since the real estate sector is all down to the bottom right now, and there is no relaxation from the government so far, and yet they are able to sell the inventory in many of the names like Suntec Realty or the Prestige or the Oberoi. I think these are almost at the low risk category available stocks. So can be looked at probably if you look at, if anybody has a view of an horizon of 2 to 3 years, then and then only one should look one should have into the portfolio. But otherwise, for short term or in a month or 2 months in the next quarter results, it is not going to perform and not going to show anything on a uptick. So I would say that. For investor, it is a good one that 2.5 years down the line, if they have vicinity, then this sector can see some sharp rebound from these levels. But otherwise, Oberoi is a debt-free company, even Prestige. So I think these are the good names one can have in the portfolio, but with long-term horizon.
Okay, Oberoi and Prestige there, both of them in focus for Yogesh. But as we're, trading down about 100 points in the Nifty, it's also important to get in a sense of what dealing room chatter is this afternoon. I'm sure, and there's a lot of concern out there as well. Darshan's joining us with some dealing room buzz. Darshan, what's happening?
Yeah, so one of the stocks that's been spoken about today is RBL Bank. It was weak last week, but over the past few days, it's given decent closing. Even in today's carnage, has managed to stay up. And look at the volumes. Almost a crore shares have already been traded on RBL Bank. There is a buzz of a potential corporate announcement that could come in on the counter, and that's something that's keeping the stock up in today's trade. The other one is the State Bank of India has recovered significantly from the day's low. Some of the large foreign brokerages are extremely bullish ahead of the SBI cards issue. There is a lot of traction that's happening on the counter. So SBI is something that dealers are talking about, and on the last stock that dealers are talking about, and that too on the negative side, and that is Tata Motors. Now has corrected significantly. Even if you take a look at the chart over the last 1 month, Tata Motors has corrected, and a while back it was trading close to 200 levels. Now it's almost 145, and the impact of the coronavirus is clearly being seen. If you saw the retail data that came out of China, there has been a massive dip as far as passenger car is concerned, over 20% year-on-year drop, and JLR gets a lot of its revenues from China, and that was one market that they were betting on for recovery, and that is certainly not happening. And look at the carnage, down over 22% in 1 month, and dealers believe that there could be more potential downside coming in on Tata Motors going ahead.
Okay, thanks a lot for that, Darshan. So that's what the dealing room chatter is. Now, RBL Bank, of course, remember, aside of the corporate development that we spoke about, also this story that Anthony did also gives that bit of a leg up to that stock, RBL Bank as well as Yes Bank. So you've got to keep that at the back of your mind. Our capital market activity is still very buoyant because companies like CDSL, etc., are still doing okay. I just wonder, Yogesh Mehta, CDSL, we've spoken enough about companies like HDFC AMC, Arnam, Motilal Oswal, etc. What about CDSL? Is it a good stock to check in right now?
CDSL, I was just reading that 2.5 months back when I was amazed with the number of demat account gets opened, and this is the annuity business which have no implications of anything on a global slowdown or the domestic slowdown, and the event like SBI card IPO or the Coal India IPO or the R Power IPO was always an immense opportunity for these companies to grow the businesses in exponential infinite percentage opportunity. So I believe that this annuity business is going to grow by at least 15-20%. Interoperability between the BSE and NSE is also providing a significant push to the business and to the income for this balance sheet for this company. I believe CDSL could be a good portfolio stock having a 2 to 3 years down the line, 2 to 3 years horizon. I think this company can grow exponentially from here since the penetration level is very low. And currently it is available at 280, though the valuations are very much fair right now, not so attractive. But the growth which I'm looking at, that at least it will grow by 15-17% in next 3 years on the PET growth. In the mid-cap valuation, this company is available at a decent fair valuation. One can look at this company to accumulate from current price to at least if it comes down to 10% or so correction, one can keep on accumulating.
Okay, that's CDSL for you. Not doing anything in today's trade, but certainly last 6 months it's given you very good returns. The counter is up about nearly 50% in trade. We've recovered once again from the lower levels. Looks like maybe the closing comes about around the 200-day moving average. I just want to pull up, if possible, the 11,700 put. Remember, when we started the show, almost 21 lakh shares were written there, or added there, pardon me, and now it's just about 4.2. That's giving you an indication. Intraday unwinding has taken place. When we started the day, majority of the session we were trading above the mark of 11,700, but Europe fell in trade. You had the Dow Futures falling, and since then our markets have breached the 200-day moving average. Bulls were looking to defend that mark, but looks like it will be not possible, and tomorrow is also the expiry day, so keep that in mind. Volatility is certainly on the higher side for that. And 11,000 call, by the way, has seen aggressive riding now. When we started the day, started the show, only 8 lakh shares were added there, and now almost 16 lakh shares have been added there. All right, just 10 minutes to go for markets to shut shop, so let's get you some closing strategies from our techies. Brajesh, let me come to you. Is there any STBT or BTST for tomorrow's session?
It's STBT. Ashok Leyland, after making a high of 84 or 86 around, it was trading in the range of 78 to 85, and 78 is a 200 simple moving average. Now it has been broken and the stock has been trading down. So one can take a STBT in it with a strict stop loss of 79 rupees 50 paisa. And the previous swing low was somewhere around 74, so that can be kept as a target. So one call is that, and another STBT would be Piramal Enterprises. The stock had been trading with the increase in volume. It has been beaten down somewhere around 14.25. The stock has been quoting. So present rate can be used for going for a sell side with the stop loss of 14.60 and play for the target of 13.85 to 13.90.
Remember, both these stocks, by the way, Piramal as well as Ashok Leyland, were sharply lower yesterday as well. I think they fell 5% respectively even in yesterday's session. Richard, what about you? Your closing strategy would be?
Well, I would recommend going long on one of the mid-cap name, that is Sonata Software. Well, during the entire month of January, we have seen a good amount of up move with good volumes in the stock, and most of the February month has been a consolidation. So this has led to formation of a bullish flag pattern on the daily as well as the weekly chart. And today again, if we look along with the price up move of about 2.5%, the volumes are much better than what we are usually seeing on a daily basis. So I think irrespective of market move, tomorrow or in next few days, we should see the stock resuming its uptrend. So at current levels for BTST perspective, I would recommend going long on with a stop loss below 336, expecting target around 358. But yes, from a short-term view, the probability of the stock going higher towards 375, 380 looks much higher.
Okay. Long call coming in from the broader market space on Sonata Software. Yogesh, do you bottom fish anywhere right now? Any stock that you've been bullish on and you're getting better levels currently?
I'm just looking at on the metal sector where I think JSW Steel provides a good opportunity, but it has not corrected much. So I'm just keeping a watch on that. And the list is, I'm just preparing, but I'm definitely, yes, gun go about from to accumulate from 11,600 or the current level 11,700 to 11,400 to the portfolio, building a portfolio of fresh companies, where one of those would be, of course, JSW Steel, which I'm looking at to accumulate from current level. Even Metropolis, which is a growth story I'm looking at, but it is all-time high. But definitely, yes, it is a growth story. Even Titan, I like to add from the current levels. So far, I was under opinion that I will have a correction further, and 1100, 1150 would be a good level to enter into. But post is, I think 1250 or odd is a good level to accumulate from current levels to say 1200 till 1200.
Okay, we'll let you go on that note. Yogesh, thank you very much for joining us. Really appreciate you taking out the time. All right, market's still down 1%, still under the 200-day moving average. You're going to see the close of this, whether or not it can take support and at least have a close above that. But any which ways, 11,700 has been breached on the downside. That's a major cue anyways taken from there. Other stocks, Vinati Organics is holding steady ground, not as much. You would have anticipated the stock to do better once the clarification came in from the management. I think the day the clarification came in, that was the day that the stock moved up 6%. Post that, extremely flat, not too much of a move or a sentiment change on the stock yet. But at 1011, Ruchit, what would you do with the Vinity Organics?
I think last few days the stock has seen more of a time-wise correction in this range of 1050 to 950. So next directional move should be seen only on a breakout either above 1050 or below 950. So I think from a technical perspective there is no trade setup over here. But yes, if we see a breakout above 1050, then I think it would be ideally the stock should enter a good momentum on the higher side. So one can have an approach to buy on breakouts above 1050.
Okay. The stock, though, in the morning session, I think the high of the day was somewhere closer to 1035. From there, it's come off a bit. Tata Motors is the other one, and the move out there has been pretty volatile over the last few days. Brijesh, would you be a buyer of Tata Motors at 144?
One can look out for going short with the stop loss of 149.5 and play for the target of 135 to 136. Still, overall trend has been looking weak on the hourly chart, which indicates the probability more downside.
Pull up Aarti Drugs. I think it suddenly shot up in trade. It's also touched its 52-week high right now. 764. The volumes around 3 lakh shares have been traded, so not bad. Richard, with the move that we've just seen in the last 5 minutes of trade, would you take any bet here or any higher levels from here as well?
I think the first level that the stock should test in near term is the previous highs of around 840, 850. So I think yes, the overall trend continues to remain positive. Even volumes, if we see at current levels, also the volumes are quite good. So if we get any minor dips around 730, 725, again, ideally the risk-reward ratio would become favorable over there to create fresh longs, keeping stock below 700 for targets around 830.
0.69% for Aarti Drugs, and that's quite a showing in the session today. Well, one question, Ruchit, to you, and 2 names from the chemical space which have done very well. Maybe you answered one about alkyl amines already, but that or Neogen Chemicals, which is up at about 10-11% as well. So both these stocks of 13% for Neogen, both these stocks trading at their life highs. Which chart looks stronger?
So Neogen Chemicals has limited historical data, since it's not that after listing the stock has the time is very limited. But yes, the alkyl chem, the trend continues to remain positive irrespective of what the corrections that we have seen in the mid-cap space during last year. It has not affected the stock, and even at current levels, the good thing is that the volumes, in spite of the stock delivering very decent returns of about 35% in last couple of months, the volumes even at current levels are growing higher. So I think the trend should continue to on the higher side, maybe around 1900, 1950 levels could be the levels that could be tested. 20 days exponential moving average is the trailing stop loss that one should continue to ride on the stock with. 1600 could be the stop loss for existing long positions, and any minor dips, use that as an opportunity to create fresh longs in alkyl chemicals.
Quite a move really on that one as well. It's left its peer Balaji Amines way behind in the last 1.5 odd months. But stay on, gentlemen. Let's start wrapping up the markets. The bank Nifty is a lot well behaved, I must say, compared to the Nifty and the Sensex. So those two have come off. Largely, I reckon, because of the exposure to global cyclicals. Nifty Bank largely exposed to domestic companies. I don't think too many banks have that kind of exposure except for those companies, and that's why maybe the market is doing this discerning change. But nevertheless, you never know what could happen tomorrow. For today, banks are well behaved, which is a good sign. A heavyweight space. Wonder what would happen to the Nifty if the banks too would have corrected. The mid caps and the small caps were in the green to an extent at the start of the trading day or midway through the trading day. Again, a lot more well behaved, just about 0.6% compared to the mid caps, which are down about 1%. But the market breadth still ending in the negative, though I think that the breadth would have improved compared to what it was midway through trade today. Let's talk about specific stocks. And Yes Bank 5% higher in trade. There are gains for Bharti Infra, SBI and Britannia as well, and some gains for HDFC Bank. That's quite interesting. It's moved back and I think that's the reason why the Bank Nifty has gotten that support, that intraday of HDFC Bank. We'll talk about it a bit later, but do watch out for that one. I think that's probably one reason why the Bank Nifty has clawed its way back. Gale 5% lower. Tata Motors continues to grind lower. Hindalco, Maruti, Larsen & Toubro, Infosys, those are a few other names, and Reliance continues to grind lower. Now, we were wondering why this market is doing what it is doing despite the Bank Nifty doing okay. Is because of Reliance and TCS, both heavyweights, down about 2% apiece. Very difficult for the index to do very, very well when both of these are down. The only good part, as I said, is that HDFC Bank is not. But Navneet, the broader markets, the breadth negative, but I think a shade better than what it was at somewhere around 11:30.
That's right, Neeraj. The breadth, I think, right from the word go today was a negative, but certainly there were a couple of pockets which did well, even in a weakish market like today. So let me begin with the gainers. India Cement, of course, by now we know why the stock's been moving higher since yesterday. It was locked in upper circuit today as well with gains of 20%. You had something like Spencer's, which moved higher in the second half of the trading session, as you can see on your screen. And by the way, this one's also closing with gains of 20%. That's the circuit limit. Interesting moves coming in for BASF. The counter attached its 52-week low today, and from those 52-week low levels of 803, it's closing at levels of 934 with gains of 13%. And we've been discussing how chemical companies have been doing well, and especially the ones which are gaining due to coronavirus. One of them being IOL Chemicals, which is up about 60% now in the month of February due to ibuprofen prices moving higher. And you had Fairchem Specialty too, which surged in today's session. That one is closing with gains of 10%. And of course, DMart in a weak market like today gave you some marginal returns. It was okay, maybe it gave up then towards the end, but still I think it's closing the day in the positive territory. On the losing side, you had a New India Assurance, and this one was weak, I think, for majority of the session, as you can see, and also closing around the lowest point of the day, down 6%. Motherson Sumi, after a short covering bounce yesterday, this one was back in the red and down almost 4 to 4.5%. Has been trading below all its key moving averages. Piramal Enterprises was down 5% yesterday. There were signs of shorting coming in on the futures market, and today as well the counter fell by about 4.5%. Thomas Cook had a board meeting to consider buyback. We don't have the details right now, but ahead of that the counter was down 10%. Lemon Tree, second day on the trot. Yesterday was down 7 to 8%, and today the counter is closing at the lowest point of the day. From the metals pack, Jindal Steel and Power was down today, down about 4.5 to 5%, and also Tata Power, and this one was weak right from the word go in the morning when the markets open, and Tata Power is closing the day with cuts of about nearly 4%.
1% plus under for the Nifty 50. That's down about 122 points, 11,675 on a closing basis for the Nifty 50. Banks are relatively much better placed than the index itself. So 30,329 on the Nifty Bank. Sensex is down 1% as well. And we know the clear contributors on the downside, obviously those cyclicals, auto companies, and the big two names there, Reliance Industries and Infosys. I mean, it's not, you've got the bulk of the share here, but you've still got another bulk of the losses being added up by some of the other names in the auto, the metals pack. Gaining is SBI, HDFC Bank doing okay, and HCL Tech also supporting, but marginal gains coming in there.
Yep, and we've been breaching some crucial levels since yesterday. We closed below 11,800, and today it's just not about 11,700. I guess we'll wait for the adjusted rates, but at least for the last rate, 11,675 seems to be a below 200-day moving average as well. Want to pull up the volatility index first before we look at the market breadth, and VIX was up 8%. Remember, and this is coming just one day before the expiry. Monthly contracts expire tomorrow. 18.3 is pretty high, even if the markets were to recover from these levels. And finally, let's just take a look at the market breadth. I'm sure it's in favor of the declines. That's how it has been throughout the session, and the ratio widened towards last half an hour of trade.
Turnover is going to be important as well. So 40,000 crores, you would have anticipated this number to be higher considering the ferocity of the sell-off. And 19 lakhs ahead of the expiry tomorrow. That's probably normal to see that kind of a figure. Closing comments from both the technical experts. Brijesh, come to you first. Tomorrow is the expiry day for the February series. All the more important. What are you going to watch out for?
See, Devina, no doubt banking stocks has saved the market, and the hourly chart had made the candlesticks of a bullish hammer pattern, and the oscillators are making the higher lows, which indicates the bank Nifty might try to touch a level of 30,500 or say 30,550. Might be tomorrow or in Monday session. But the only culprit for the market to move down are the IT stocks, whether that be Infosys, TCS, or even the heavyweight Reliance. I have been watching the Reliance daily charts. It's been trading with the lower tops and lower bottom formation, and the previous swing low is 1363, and the 200 simple moving average value is somewhere around 1375. So these are the two important levels to be watched keenly for the Reliance. If this had breaks, then there might be a more selling pressure for the Nifty, and Nifty might try to retest its previous swing low, that is 11,615. So Nifty component as well looks weak, whereas the banking stocks are looking fine. So one can play on a long side for the Nifty, but for the bank Nifty, but Nifty is looking weak. So we might see that Nifty might retest the previous swings low.
So bank Nifty, like Brijesh said, is a better option there. Ruchit, your closing thoughts?
See, today post opening, the 200-day moving average at one point of time acted as a support, but what we had seen that on pullback move, again selling pressure game. So this is an indication that the undertone continues to remain bearish. But since we've already seen a good amount of sell-off in last few trading sessions from 12,200, we are already towards 11,000, below 11,700 now. The swing low of 11,615 of 3rd Feb would be the crucial level to watch out for tomorrow. Yes, we are advising clients to remain light on positions since the volatility index has also spiked and market is trading near the support. So I think the index would continue to show the higher volatility the way we have seen in today's trading session. So staying light on positions, I think, would be a better strategy for next few days.
Okay, gentlemen, thanks so much for joining in today and giving us your perspectives. Really appreciate your time. And as we end the show, the disruptor in the online brokerage space, Zerodha, is now looking to enter the mutual fund space. Late last week, founder Nitin Kamath put out a tweet saying that they have applied for an AMC license to grow participation in the capital markets and address those who did not invest, citing the millennials. I had a chance to speak to Nitin on the rationale behind this move and how they would proceed. Listen into that conversation.
We've spent 10 years in this business, and it started off catering to active traders, then it became investors. Then we started a mutual fund platform, direct mutual fund platform called Coin. And the experience over the last 10 years, what we have realized is the markets aren't really expanding as much. I think the entire country has between 1 to 1.5 crore people who actually invest in the markets. And potentially this could be 3, 4, 5 crores, and I think, as brokers, we are just a user experience on top of people who are manufacturing products, right? And so now, the belief here is that if you want to get the new bunch of 20 to 30-year-olds, the way mutual funds were designed, probably, someone has to give a shot at doing it in a different way. So we are not really, attempting this to go after the existing investors because I think they're all taken care of quite well. This is focusing on the new bunch of guys who are currently not investing in the markets.
So what is this? Is this a reimagined product idea in the way it will be done and in the way it will cater to the kind of clients? Because your mention, and I only have your tweet as a reference, speaks about how you want to focus on the millennials and not necessarily the entire landscape.
Yeah. See, the thing is, there are a bunch of threads that are running, right? As in, the easiest one I think that we will definitely go for is something like the Vanguard retirement funds, the target date funds, So, because today I think, people don't really have the, background of financial markets. So if you start off selling a mutual fund saying small cap, mid cap, large cap, you have lost the person right at the go, So I think today when people are allocating funds, they just want to allocate for investing and forget about it, right? As in, especially the younger bunch, who don't really have as much bandwidth to sit and figure out, and this mobile phone that we have, which is always distracting all of us, So people are looking at an easier solution, I think, but still, it's still early days, I think we just got a lot of press around this. We've just applied. So firstly, we need to first get approval in place, and so it's still a long time away. But the multiple threads running. Yeah,
No, of course. I mean, this interaction with you, Nitin, is not as much about what would Zerodha, I mean, what would it mean for Zerodha, as much as it means for what it could mean for the landscape. So, and which is why I was asking whether you're trying to reimagine the way it is done. Now, I heard you mention that you might, I mean, and I'm guessing it's early days, but you might look at a model which is similar to Vanguard did, so on and so forth. So, are we looking at, or are you thinking on the lines of passive, low expense products which are simple and thereby trying to get in a set of people who you think are not biting the bullet because they find the existing products complicated?
Yeah, I mean, see, the thing is, stock picking is not our core competence, So as and when the information asymmetry in this country keeps going away, I think passive products are going to maybe start outperforming the active ones, eventually. So if we are playing it for the next 5-10 years, so we are not looking at active investing. Definitely it's going to be passive. It's going to be low cost. I think I mean, the bet is to kind of build some innovative products on top of these two things.
There are brokerage houses, or rather AMCs, let me correct myself, which are also starting off to offer such products as well, Nitin.
Right.
I mean, just wondering, would you believe that the distribution would be a strength in order to be able to reach the set of clients? Would you do cross-selling, etc.? Because otherwise, established asset management companies are anyway starting to give products like these.
No, I mean, see, the thing is, even when we started brokerage, right, as in every brand needs to be known for something. I mean, an active manager today selling some passive products is not like a passive only fund. I mean, in the sense, there are so many conflict of interest, within an AMC if they're also doing active and passive, right? As in, if you're going to make more money selling active, how do you sell passive, right? So there are, there are a bunch of conflicts that exist, when a same brand is doing, conflicting kind of businesses. So, I mean, if we do this, it will be completely passive. So maybe, you need a brand in this country who will come and say that we are just passive and promote the whole concept of passive, in its true sense, yeah, but still early days, as I said.
Agree completely. Okay, just a couple of questions though. I mean, I'm guessing you've thought this through, but just so that I understand it better, Nitin, you anyways have this very large distribution platform, which I presume caters to almost all AMC products available under the country, and yet you will go out and launch an AMC of your own. Would there be a separate housing or a conflict to address the conflict of interest that might come up as a result of that?
I mean, this is going to be a separate company altogether. I mean, it's going to be at arm's length, all Chinese walls, etc. And if you look at it, right, I mean, the biggest banks in this country are also the biggest AMCs. They're also the biggest distributors. They're also the biggest brokers. So, I mean, and they've done this all well by keeping a distance between all the businesses separately. So we intend to do it the same way. Keep it as a separate business, away from the broking business.
Okay, just one last question, and again, it brings me back to the rationale that you gave at the start of this interaction about why are you intending to do this, amongst other things that you mentioned, that the number of people or number of investors is largely not growing. Now, I know by looking at the flows that the quantum of money getting invested into mutual funds has increased quite a bit in the last couple of years at least. Right. In your experience with the clients that you have, does your research indicate that the large number of people who might be doing equity trading or investing with you, or in some form or the other are connected to you, are still not becoming mutual fund investors? Is that a real data that easily prompts you to start this?
No, I mean, see, the thing is, I think today the entire broking industry is catering to the top 15, 20 million Indians, right? As in, and we are kind of a subset of that. No, we do have a decently large size direct mutual fund business. We have powered over 10,000 crores of investments. So this isn't, as I said, I mean, the entire bet here is not, to build this for the top 15, 20 million Indians, for which everyone else is already building their businesses. I mean, this was to go after the 20 to maybe 50 million, that category of Indians who currently, are filing income tax returns, or probably have some money with them at the end of the month, but aren't really bringing it to the capital markets, right? So this was, saying, can you offer a differentiated experience to attract them to the market? The bet is that.